Inflation cools down. A look at the numbers. The Consumer Price Index for April 2025 offered a glimmer of hope for those concerned about rising inflation. The headline CPI, a broad measure of inflation, rose by 2.3% year over year. This is significant because it represents the lowest annual increase since February 2021. The report suggests that inflation might be finally cooling down. On a month-over-month basis, the CPI increased by a mere 0.2%. This is a notable deceleration compared to March's 0.1% decline. This easing of price pressures is encouraging, especially considering the ongoing trade war and its potential to fuel inflation. However, it's important to note that certain sectors are experiencing more pronounced price increases than others. For instance, shelter costs continue to be a significant driver of inflation, accounting for over half of the overall CPI increase in April. This suggests that while overall inflation might be easing, certain sectors are still under pressure. The April CPI data paints a mixed picture of the inflation landscape. While the headline numbers suggest cooling inflation, the devil is in the detail. Sector-specific pressures, particularly in housing, highlight the need for a nuanced understanding of the inflationary forces at play. The Federal Reserve will need to carefully consider these factors as it charts its course for monetary policy in the coming months. Tariffs and their subtle impact. The ongoing trade war, characterized by the implementation of tariffs, has been a source of uncertainty for the global economy. The impact of these tariffs on the April CPI data appears to be minimal, at least for now. This is likely due to the lagged effect of tariffs on consumer prices. It takes time for businesses to adjust their pricing strategies in response to increased import costs. However, there is evidence to suggest that tariffs are starting to impact specific sectors. Furniture, bedding, appliances, and toys are among the sectors that have witnessed price increases, likely driven by tariffs. These sectors are heavily reliant on imports, making them particularly vulnerable to trade tensions. The muted impact of tariffs on the April CPI data should not be misinterpreted as a sign that they are not a concern. As businesses continue to adjust to the new trade environment, the impact of tariffs on consumer prices is likely to become more pronounced in the coming months. This is a development that the Federal Reserve will be watching closely as it assesses the inflationary outlook. Expert opinions, a mixed bag of predictions. Economists and market analysts are divided in their opinions about the future trajectory of inflation. Some experts, like Ryan Sweet of Oxford Economics, believe that the impact of tariffs on inflation is yet to be fully realized. He argues that the minimal impact observed in the April CPI data is temporary, and that tariffs will contribute to higher inflation in the coming months. Seema Shah of Principal Asset Management offers a more cautious perspective. She suggests that the April CPI data might not fully reflect the impact of tariffs due to recent developments in trade negotiations. The on-again, off-again nature of the trade war has created uncertainty, making it difficult to gauge the full extent of its impact on inflation. The divergence of expert opinions highlights the uncertainty surrounding the inflation outlook. The Federal Reserve, tasked with maintaining price stability, faces a challenging environment. The mixed signals from the CPI data and the unpredictable nature of the trade war make it difficult to accurately forecast inflation and formulate appropriate policy responses. The Fed's Balancing Act, navigating uncertainty. The Federal Reserve is walking a tightrope as it attempts to balance the risks of rising inflation against the need to support economic growth. The April CPI data, while offering some comfort, does not provide definitive answers about the future path of inflation. The potential for tariffs to fuel inflation in the coming months further complicates the Fed's decision-making. Given the uncertainty, the Federal Reserve is likely to maintain a data-dependent approach. Future policy decisions will be guided by incoming economic data, including inflation, employment, and economic growth figures. The Fed will need to carefully weigh the evidence and be prepared to adjust its course if necessary. The Federal Reserve faces a delicate balancing act in the current economic environment. The conflicting forces of easing inflation, potential tariff pressures, and the need to support economic growth demand a nuanced and flexible approach to monetary policy. The coming months will be crucial in determining whether the Fed can successfully navigate these challenges and maintain price stability without jeopardizing economic growth.